Which is the better dividend stock to buy, McDonald's or Domino's? I'm going to answer that question in this video looking at 5 different metrics. So let's get right into it. Starting with the dividend yield, McDonald's offering a better 2.15% dividend yield compared to the 1.27% dividend yield of Domino's. But don't count Domino's out just yet. That's just one of the 5 metrics we're going to look at. The next thing I like to look at is the dividend payout ratio. This measures the percentage of earnings per share a company pays out in dividends. And for me, it tells me a lot about the sustainability of the dividend. A smaller ratio tells me there's more room to increase the dividend and there's more room to keep the dividend stable in case there's something that shocks earnings per share lower. And in this regard, Domino's at 32.89% is more sustainable and has more opportunities for growth than McDonald's at 69.10%. The next metric I want to look at is quarterly year-over-year revenue growth, because a company with growing revenue is likely increasing its earnings per share as it leverages its fixed expenses and at least shows small percentage increases in earnings per share, which then of course with greater earnings increases the room to pay greater dividends. And in this case, McDonald's had wildly fluctuating revenue growth after the pandemic. Of course, it crashed initially as its restaurants had to be closed for in-person diners, and then in the year after that it exploded to over 40% revenue growth for at least one quarter, as the company did an excellent job utilizing its digital, emphasizing its digital ordering platform, partnering with third-party delivery providers, and really growing that side of the business. Domino's, meanwhile, really benefited during the outbreak. If you're stuck at home, ordering pizza seemed like it was a tailor-made business model for the pandemic. Of course, it thrived during those times and then it faced a bit of a headwind, but now revenue growth has accelerated again, 7% year over quarterly revenue growth. So Domino's, even looking back historically, has the advantage over McDonald's in terms of revenue growth. Next, let's look at that earnings per share I mentioned earlier, and we're looking at earnings per share diluted for the TTM, which stands for trailing 12 months. McDonald's showing nice earnings growth going back before 2014. We could see an upward trend here, less than $6 earnings per share, up to $7.94 most recently earnings per share. So a nice upward trend, and of course growing earnings leaves greater room for dividends. Domino's, meanwhile, is showing even better earnings growth, less than $4 per share before 2014, all the way up to $12.36, growing more than 3x its earnings per share. And another favorable metric for Domino's in this comparison over McDonald's in terms of dividend payments and dividend growth. Finally, let's look at their valuations, and I'm going to look at the price to earnings forward ratio. So looking at what the companies are trading for according for the forecasted earnings over the next few quarters. And looking at this metric, they're trading very similarly. McDonald's at a valuation of 25.65, Domino's at a valuation of 24.07. So very similar valuations, small discrepancies there. So if I had to answer this question, which of these stocks is better for dividend investors today, I'm going to say Domino's stock is the better investment for dividend investors right now. It's got better prospects in terms of earnings per share growth and better prospects in terms of revenue growth over the next 3, 5, and 7 years. So that's the one I'm choosing. And that's the one that I think would be the better investment right now if you're an investor looking for passive income. All right, that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.